Okay, welcome back. This is the second in the series of short revision videos updating students on key recent developments in the UK economy in 2019. In this video, we look at developments in household spending and saving, asking, for example, what's happening to consumer confidence, what's happening to the amount people are willing and able to borrow, what's happening in the housing market, and also should we be concerned about the steep fall in the household savings ratio. First of all, consumer confidence. These are indicators of consumer confidence. A fall in the chart here is indicative of a deterioration or a worsening in consumer sentiment or animal spirits. And the chart shows, as we head into the spring of 2019, that consumer confidence in the UK is dropping. And it's hard not to make a link here with the wider uncertainty surrounding Brexit. But developments in the housing market might also be contributing. The blue line shows people's confidence in the general economic situation, and at the moment that level of pessimism, if you like, is deeper than for their own financial situation. The orange line shows confidence about personal financial position, so perhaps people are a little bit more confident about their own finances, expecting the worst won't happen to them. But the indicators are heading south and have been for a little while. What about the household credit situation? The chart here shows the annual percentage growth of consumer credit. That includes things like money borrowed on credit cards and other unsecured loans. Average household debt in the UK was over £58,000 in June 2018. Of course, a lot of that is mortgages. The average debt independent of mortgages is around £15,000. But crucially, overall, in the UK, in the summer of last year, people in the UK owed nearly £1.6 trillion. There is a huge amount of household debt. It's about 135% of GDP. Now, the rate of growth of consumer credit is falling, and that is often a sign, if you like, a forward indicator that perhaps the growth rate of the UK might be about to dip. Consumer spending, of course, is the biggest single part of aggregate demand. So this is a chart that's well worth looking at. There's some concerns, for example, about the surge in borrowing linked to car dealerships, buying new cars, personal loans, credit cards, etc. If interest rates start to go up in the UK, there are millions of people whose ability to repay their debt is highly sensitive to changes in interest rates. Here's a quiz question for you, just have a little go if you want to have a go at this. To the nearest £50,000, what do you think is the average house price in the UK economy? To within £50,000, what do you think is the average house price? Jot the answer down and let's see if you can get close to the right answer. Well, the average house price in the UK is shown by this chart. It's taken from the Halifax House Price Index, and as of January 2019, the average price was £230,000. There has, of course, been quite a significant increase in prices, average prices, since the low of 2008 to 2009 following the global financial crisis. House prices marked time a little bit, but since then they have risen quite sharply. In some parts of the country, of course, prices are way higher than that. But in fact, the rate of growth of house price inflation is slowing down. Here's a chart that shows that. I'm just going to go flip back a chart. Can you see here that the growth rate does appear to be leveling off a little bit? And if we convert levels into percentage changes, we get this chart. Follow in particular the orange line here, which shows the annual rate of growth of house prices for London. And of course, London prices have been rising sharply. If we go to 2014, in the middle of 2014, they were increasing at an annual pace of 20%. In the spring of 2016, they were still rising in excess of 10%. But have you noticed just how steep has that growth decline been? Indeed, house prices on average in London are now falling because the percentage growth chart has fallen below the zero axis. The northeast, prices marking time, rising by about 2 or 3% per year. Overall, the UK economy is seeing a slowdown in house price inflation, now well below 5%. Well, that's good news for some people who need to be able to get on the housing ladder and perhaps afford a mortgage. But of course, millions of people own a home or have a mortgage, and they're looking for house prices to rise. Finally, a word about household saving. This is one of the key charts we look at in macroeconomics. The savings ratio is simply the percentage of people's disposable income, that's income after direct taxes and plus welfare benefits, the percentage of disposable income which households save. Now, my chart takes us from the tail end of the last recession in 2010 through to the latest figures for 2017-2018. And you can see here that there has been quite a steep decline in the savings ratio. It was as high as 11%, nearly 12%, 9 years ago. Ups and downs along the way, of course, you'd expect that's part of the economic cycle. But the savings ratio is now close to or at 5% of disposable income. Some economists are quite worried about this because if the economy goes into a recession, the Bank of England is forecasting there's a 1 in 4 chance of recession in 2019, then many households simply do not have the savings to be able to act as ballast if they suffer a fall in their incomes, or perhaps if they experience an increase in unemployment. I think a lot of economists would prefer household saving to be a little higher than that, perhaps closer to 8%, so that people are able to save a little, put some aside, and also perhaps save some extra money to help pay off some of their debts. So the savings ratio is quite low, and I think at this stage of the cycle it really should be a little higher than that. That's a cause for concern. But of course, if you're a saver, why would you save? The rate of interest on deposits is probably less than 1%. Let's say inflation's 2%, in which case the real interest rate on savings is actually negative. So there we go. There's a quick update on some aspects of consumer spending, house prices and saving.